Joining us now is Chris Murphy. He is co-head of derivative strategy at Susquehanna Financial Group. Big players in options and big players in market making in GameStop as well, by the way. So it's an important interview, Chris. By the way, I think you're first ever on CNBC, so welcome. In layman's terms, and not using terms like gamma squeeze, tell us exactly what is happening with GameStop and others vis-a-vis their options.
So, the GameStop situation has been widely reported. Epic short squeeze, coordination of retail on the message boards being a major catalyst. In my opinion, I think the call volume has come after that. We've been watching all of this retail, what we call message board call volume, and it typically chases momentum as opposed to being the catalyst for it. And the reason I can be confident in saying that is I think people will be surprised to hear that open interest in GME calls from the beginning of this year to now pretty much has not changed. So we're talking about open positions in the calls since the beginning of this year when GME was 13 till now. So what is that telling us? All of this call volume on a daily basis appears to be chasing the momentum as opposed to causing it. You see opening and closing in the same day. And at the end of the day, you don't see much of a change in the open interest in the most active call strikes. And that's different than what we're seeing on the put side right now.
So how much of this is really deep out of the money call buying, Chris? And again, for our audience there, and I'm not going to pretend I'm a pro either, if a stock's at 100, you might buy a call option at 200. You're buying placing huge long-term bets on fast and aggressive price appreciation. So if it hits those targets, you can mint a lot of money. And by the way, many people have. How many of these options bets are on names like a GameStop are spectacular out-of-the-money bets that have been, by the way, paying off?
Well, a huge proportion of them are. Part of it's, they're less, they cost less. You can buy more of them, things like that. But what is interesting is you'll see this huge amount of volume, let's say in a $50 out-of-the-money strike that expires in a week. In theory would be somewhat unrealistic, but then you look at GameStop and maybe not. But at the end of the day, when you look at the open positions that are carried into the next day, you don't see much of a change. So what that's telling you is these call buyers or call traders are holding on to these positions for less than a day, opening and closing over the course of the day, sometimes multiple times. So what you'll see is, for example, yesterday you have more call volume trading in one day in GME than the total number of existing positions heading into that day. But because all those, sorry, go ahead.
No. I honestly, Chris, I don't dig into options trades for a living, no doubt, but I'm not sure I've ever heard of the call buying and selling volume exceeding the volume of the calls that are available. So what you're saying is there are people who are clearly buying and selling options multiple times on GameStop during the same day.
Yeah, just to break it down, we're talking about the volume number, the number of calls that change hands over the course of one day versus the total open positions called open interest that you see the next day.
Shepard Smith here. Thanks for watching CNBC on YouTube.